All right, welcome back everybody to today's class. And in today, we are continuing on our journey with life insurance class. And we will be continuing with chapter 4. All right, I'm not going to, I hope the class is going great for you also far. I hope you've been consistent. Hope you've been staying on track with whatever you plan to achieve within the scheduled time frame. All right. If you have any question, don't hesitate to leave it in the comment section. I'm going ahead to share my screen. My goal today is to see if I can finish chapter 4 and right immediately do the chapter 4 question and answer all in one class. But we'll see how that goes, okay? All right, in chapter 4, we will be looking at universal life. All right. Now, right off the bat, we are being meant to understand here that policies issued prior to January 1st, 2017 has been grandfathered and vested rights surrounding tax advantages will be maintained. Changes to these policies might affect vested rights and should be carefully considered. I think in the course of this chapter, we're going to see what this vested right is, that the policies that were issued prior to January 1st, 2017 were grandfathered into. Okay, now we move on to transparency through unbundling. You see, universal life insurance combines life insurance with tax advantage investing. That is, policyholders do not pay premiums, they make deposits to the policy. Deposit goes into an investment account, and that account pays expenses and is the source of funds for the investing. Wow, you get that, right? You see, now, universal life is considered highly flexible type of policy for its policyholders. Universal life is the most flexible form of life insurance. Also, universal life is more complicated due to the insurance investment nature. Now, there are three factors that determine the premium for all forms of life insurance, whether term insurance, whole life, or universal life. But one thing I want you guys to understand right off the bat right here now is that universal life is the most flexible form of life insurance. Is a life insurance that put the power of choice in the hands of the policyholder through the help of his or her advisor. All right. Now, regardless of whether term insurance, whole life, or universal life, there are three factors that determine the premium that the policyholder pays. Number one is the mortality cost, that is the cost of life insured, also called the mortality charges. Okay. Number two is administrative expenses of the insurance company. Number three is the investment income. All right. Because if the investment income does well, then there will be more money for the whole life. We saw that if the investment income does well and they were able to put enough funds into the, what's it called? There's the name for it. The required pool that they needed, then they are able to distribute the leftovers with those that have participating whole life. Now, administrative costs, we look at what those admin costs were in the previous chapters, which is the cost of paying insurance brokers like myself, the cost of maybe running a medical test on the writing cost, and then different other costs that the insurance company have to undertake in the cost of insuring this person. Now, in a whole life policy, these three factors are bundled together. The policyholder does not know how much of the premium paid gets applied to to which cost or which expenses. Wow. But in universal life policies, all these costs are reviewed. Universal life policies review how each of these three cost factors is calculated and applied to an individual policy. Thus, UL policy provides transparency since information is openly disclosed and unbundling since the factors are clearly separated from each other. This is interesting. Policyholders can better understand their policy and its cash value when they have this information available to them. The cash value in a universal life policy is the value of the investment account. Wonderful. Yeah, and that's why when we run illustration, we are able to show people the cost of insurance. Yeah. Then their cash value. Interesting. Anyways, we move on to premium tax, okay? Contracts and sales literatures refers to the amount that a policyholder pays into a universal policy as deposit and not premiums. So due to their roles as both an insurance and investment options, however, for consistency, we will use the term premium exactly, because that's what we always use, all right, to refer to them. But in a nutshell of it is, they are not referred to as premium. They are referred to as deposit, all right, for universal life. Now, a provincial tax between 2% and 4% is charged on all premiums paid into a universal policy. This premium tax reduces the amount of deposits to the investment account, and the remainder of which goes into the policy's investment account. Now, the policyholder can avoid this premium tax by investing that same money outside of a universal policy. For example, by investing in mutual funds or GIC. Mortality charges. By now, you should know what mortality charges is, right? Okay, because we've seen that in term insurance, we've seen it under whole life. As with term and whole life policies, the mortality costs for universal policies reflects the insurance company's cost of paying out the death benefit. The insurance company deducts the mortality cost from the investment account. Later in this chapter, in section 4.3, you will learn that the policyholder has some choice around how the mortality costs are calculated. Administrative expenses. Okay, so we've seen the mortality cost, what it entails now is the cost that the insurance company undertake in paying out death benefits. Administrative expenses. Administrative expenses of the insurance companies are its cost of doing business. The expenses include selling costs, which involves marketing, agent commissions, I said that before. Secondly, underwriting and aging policies. So now the insurance company incurs some expenses through the underwriting. For example, if they need some medical done for somebody during underwriting process, they have to send a nurse to the person's house, to draw the blood, to run all those tests and stuff like that. All those costs, all right, are costs that the insurance company bear during underwriting process. Now, costs associated with investigating and paying claims. That's self-explanatory. And then income taxes. These costs are deducted from the policyholder's investment account as a percentage of the annual deposit to the account or as a flat monthly fee. Because of its complexity, the cost for a universal life policy are higher than for term whole life or T100. Interesting. Investment income. There are many investments from which the policyholder may choose Details about investments are discussed in more details in the investment choices section. Because the policyholder sees how the mortality cost and administrative charges are calculated, the policyholder gets a clear picture of how investments are performing. Investment growth is tax-free, providing it is less than the limit set out in the Income Tax Act. And this will be discussed more in the exemption text section. Flexibility for the policyholder. Universal life insurance provides many options for the policyholder when the policy is issued and while it continues to be enforced. Changes can be made to best suit evolving policyholders' needs. The following factors are all flexible, that is changeable in a universal life policy. Option number 1 is the timing and amount of the premium, very flexible. The face amount. Recall that the face amount is the amount of insurance taken out. Death benefit is the amount received by the beneficiary when the life insured dies. And these two sums can be quite different. Yeah, and the life. So the last one is the life or lives insured. Now, timing and amount of premium. Within a specified limit, the policyholder can decide how much and when to pay premium. Yeah. There is a minimum premium requirement. There is also a maximum premium limit and a premium flexibility in between these two extremes. All deposits go to the investment account. The minimum premium pays the life insured's mortality cost and the policyholder's administrative expenses and premium tax, and is designed to keep the policy in force until age 100. When the minimum premium is paid, the account is said to be minimally funded. And as the minimum premium is not enough to build up the investment account within the policy, the minimum premium respects the deposit limits in order to keep the policy tax exempt. When the maximum premium is paid, the account is said to be maximum funded. Now, deposit flexibility is available between making the smallest deposit and making the largest. This flexibility permits lump sum deposit and higher regular deposit to be made as desired. This premium deposit will build the investment account value. And when the account is more than minimally funded, it has more value than needed to pay associated account cost. Now, premium deposit can be reduced or stopped for a period of time, and withdrawal can be made as long as the investment account can support the insurance company's mortality and expense deductions. For example, Elaine has a universal life on her own life. The policy specifies minimum premium of $325 per month. But she currently deposits premium of $500 per month. And the policy has a cash value of $2,900. You see? So what this is saying in essence is that with universal life, we have the minimum deposit and the maximum deposit. So you can pay the minimum deposit, like I tell people, if the financial situation is not as buoyant as of yet, the individual can be paying the minimum deposit for now until their financial situations improves. However, if one chooses to pay those minimum deposits, it's not going to create a fund in the investment account. That's basically what this is telling us. And then on the other end, for someone that is putting more money, putting the maximum, that is creating enough fund in the investment account. Again, there is a limit, okay, to how much fund one can put into the universal life in order not to trigger taxes. That's why we have the tax exempt clauses, which we'll be discussing in the later as we go on in the course of this lesson, or maybe the subsequent ones. Okay. Now, insufficient account value. If the account value cannot pay the mortality cost and policy expenses, then the policy could lapse. You see, when you hear mortality cost, okay, we've explained what mortality cost. You see, it's the cost of insurance company paying the death benefit. Mortality cost is simply what tells insurance company that, okay, is remember, people are grouped in different groups based on their age, gender, health condition, and stuff like that. And in those groups, insurance company have the statistics. Okay, in this group, this is the probability of people dying, right? And then they, based on that, they're able to make projections of the cost of death benefit they are going to be paying out in that particular year. So that would be their own mortality cost. And based on those data and those statistics, insurance company require certain minimum amount to cover those mortality costs, right? And that is what that is all about. And then when there's insufficient fund, because sufficient fund is enough fund to cover mortality costs and then expenses. However, if there's no sufficient fund to cover the mortality costs and expenses, because the mortality cost and expenses is what constitute, and taxes is what constitute the minimum deposit to keep the policy going. If that is not present, then the policy will lapse. All right. Insufficient account value can, be resulted of minimum funding, withdrawal from the policy, few or no deposit to the account, low or negative investment return. For example, Elaine is pregnant and she plans to, you see, Elaine just continue from, and she planned to take 1 year maternity leave from the job, which will result in decreased income for that period. To ease the pressure on her cash flow, Elaine can reduce her premium or even stop paying premium for a period of time. If she stops the premium entirely, the policy will likely lapse after about 8 or 9 months. That is 2,900 divided by 325, which is her minimum deposit. And because the account value will be exhausted by the mortality and expense deductions. Okay, model factor for Llqp policies. Remember model factor? If you don't remember, then I would like to say you should go back. Anyways, we'll learn it more here. For term insurance and whole life insurance policies and whole life insurance policies, the model factor almost always reflects an interest charge that the policyholder must pay to the insurance company in exchange for spreading the premium out over a series of payments. All right. For most Llqp policies, the model factor is 1 divided by number of payments per year. Therefore, the insurance company does not apply the model factor to this type of policy. For example, in section 3234, example shows a term policy with, this was in chapter 2, which a model factor of 0.088, such that an annual premium of 956 became a monthly premium of 8413, calculated by 956 times this over the course of 1 year. The total premium will be this, calculated by 84.13 times 12, which is 6% higher than the quoted premium of 956. For the majority of the universal life policies, model factor for monthly payment is 0.0 833 calculated as 1 divided by 12. All right. Now, model factor for semi-annual policy is 0.50 calculated as 1 divided by 2. In this case, the annual and annualized premiums are the same. All right, we move on to face amount. Let me move my own here to there we go. Face amount. Oh, this is interesting one. Don't worry. And I hope you're following. I hope you're paying attention, and I hope you're learning. You see, my goal is to make sure that this you don't look at this as being so complicated. Really, they are not. All right. The face amount is specified when policy is taken out. The policyholder can add additional coverage to the policy in the future, subject to providing evidence of insurability. If the policy has a guaranteed insurability rider, which is discussed later in this chapter, evidence of insurability is not required. And the new premium for the additional coverage will be calculated based on attained age basis. What is this talking about? You see insurability, you see here attained age, and you see, come on, you've seen this before, haven't you? All right. This is basically telling us that a policyholder can add additional coverage. For example, somebody have 500,000 life coverage, and 5 years later, and they want to add additional 500,000. Well, they can do that if there is insurability clause in the current policy. It means that they can do that without providing any additional insurability, what's it called? Insurability, evidence of insurability, all right? Mm-hmm. But their premium will be calculated based on their attained age. What that means is that if they were 30 years, 10 years ago, when they took out this policy, 10 years later now they are 40, so their new premium will be based on this additional coverage they've taken. The premium on this additional coverage will be based on their now attained age, which is 40 years old, okay? Now, increases and decreases to the face amount of the policy are usually restricted to minimum amount, that is an increase of 25,000 or decrease of at least 10,000 to minimize the administrative costs involved in making such changes. You know, sometimes people may want to like increase by maybe little amount or stuff like that. So it depends. There could be a minimum amount that one can increase and there could be an amount to increase or decrease, minimum amount to decrease, minimum amount to increase, and the minimum amount to decrease. And this is for insurance companies, the costs, the expenses associated with making all these changes. All right. Changes to the face amount impacts the cash value in the policy, as mortality costs are directly linked to the face amount. Increased face amount leads to increased mortality charges unless the insurance company compensates by charging higher premiums. And this would lead to a smaller amount of premiums deposit being available for investments after the mortality charges have been deducted from the investment account. And this could result in the erosion of the policy's cash value. This is pretty much straightforward, okay? All right, a decreased face amount leads to a decreased mortality charge. More of the premiums deposit is available for investment, which could result in a higher cash value. For example, Richard and Mariah, ages 38 and 42, already have two children, aged 15 and 17. Richard has a 500,000 UL policy on his own life, Mariah is employed and earn a good salary and they have no major debt. Richard bought UL policy a few years ago to ensure that if he dies, Mariah will have enough money to raise the children right through their post-secondary education. Much to their surprise, Richard and Mariah have just learned that Mariah is pregnant with twins. Richard decided to increase his UL coverage by 500,000. He was able to do so within his existing UL policy. And after providing proof of insurability, if their cash flow is limited while Mariah is on maternity leave and there is sufficient cash value within the policy, Richard may be able to have this increased coverage without increasing his premium for the time being, as we will discuss shortly. Okay, so that example explains it all and it's pretty much straightforward, so there's no need to start explaining it any further. Now we're going to be looking at life and life insured. Life for one and lives for multiple insured, okay? One universal life policy can be used to insure multiple lives, either on a joint life basis, a single life basis, or depending on the insurance company, sometimes both. For example, Joe bought a universal life that includes 500,000 of joint last to die coverage on the lives of himself and his wife Sherry, and another 1 million in individual coverage on his own life. The joint coverage is payable to the estates of the last to die and is intended to be used to offset the tax liability that will be triggered upon the last of their debts on their certain estates assets. They want to live on their on the uncertain estate assets they want to leave for their children. The individual coverage is payable to Sherry upon Joe's death and is intended to help replace the family's lost income if Joe dies first. This is good stuff. Now, the ability to substitute one life insured for another is unique to UL. The substitute person must provide evidence of insurability. For example, Cheryl is no longer able to care for their young children because she was paralyzed in an accident. Joe's sister Deborah has moved in with them and she has become an integral and essential part of the family. Joe decided to add Deborah as a new single life insured under his existing UL policy. Deborah had to provide proof of insurability before Joe could add her to the policy. Awesome. Pricing. Pricing the insurance component. The mortality cost. Deducted from the investment account of a universal life policy are reflections of the net amount at risk and the mortality costing method used, which takes into consideration the following: the net amount at risk, NAAR, whether the mortality cost is based on yearly renewable term, or whether the mortality cost is based on level cost of insurance, or whether the mortality deduction is guaranteed or adjustable. So these are the different ways that the pricing of the premium is calculated. We have YRT, level cost of insurance, or guaranteed or adjustable. All right, net amount at risk. Now, the insurance company's risk in any policy is the amount that must be paid as a death benefit. That is the risk. That is what the insurance company is concerned about. That's their own risk, okay? The policy reserves that the insurance company builds up over time decreases the amount at risk. This tells us that when the policy is new, the amount at risk is very high. But as the person continues to pay, the insurance company is building up reserves to a point where the amount at risk will be reduced drastically. And that risk is called the net amount at risk in universal life policy. Now, this net amount at risk is death benefit minus investment value. The calculation and the way to calculate the net amount at risk is death benefit minus investment account. You want to write that down? Because if they give you, let me actually get some sheet from the paper. All right. So the amount at risk, which is NAAR, is equal to the death benefit, okay, minus investment account value. All right. Now, note that the death benefit in this formula refers to the full amount payable upon death. Okay, so this death benefit they are talking about is the full benefit. Because of, even me myself, I was just thinking, okay, how about increasing death benefit? You see, increasing death benefit, yeah, so that is the full amount, combination of, okay? Now, therefore, the higher the value of the investment amount, the lower of the net amount at risk. The lower the net amount at risk, the lower mortality charges they account to the account, okay? And the lower the mortality charges, the more the investment account can grow. Oh my God, this is so like a web, like a cobweb. For example, Patrick owns a universal life with a death benefit of 500,000, an account value of 128,000. Now, the current net amount at risk of his policy will be 372, which is calculated at 500,000 minus 128. All right. Now, yearly renewable term cost of insurance is expressed as a dollar amount per 1,000 of risk for a universal life policy per 1,000 of NAAR. Now, mortality cost is equal to net amount at risk multiplied by cost of insurance divided by 1,000. So we've seen NAAR, how to get it, and now mortality cost is equal to NAAR, which is net amount at risk, multiplied by cost of insurance divided by 1,000. Example, suppose that for the current policy, a purchase policy has cost of insurance of 18.57, and the insurance company will make a mortality deductions of 6,908 from his account. So this will be calculated that this 9AR times 372 divide by 1,000, okay? A policyholder can choose between two ways of applying the risk of death to the net amount at risk: yearly renewable costing, level of cost of insurance, as discussed below in section 433. Now, for term insurance, mortality cost for a period of time, the risk that the life insured will die during that period is equal to probability of death multiplied by death benefits, okay? Now, YLT is a 1-year term insurance that renew at the end of every year, all right? So it means that the cost of insurance is calculated every year. And the reason is because as you get older, your cost of insurance is increasing. It's costing the insurance company more money to insure you as you get older. Okay? The cost of universal life insurance based on YRT per 1,000 at risk increases each year because the risk of death increases with age, with the exception of the first few years of life. All right? Now, that is YRT for you. Level cost of insurance. Mortality costing based on a level cost of insurance is based on the premium for a T100 policy, for which premiums are guaranteed to remain level for life. The amount at risk remains constant, and the risk of death is spread evenly over the duration of the policy. For a universal life policy, for a UL policy based in level cost of insurance, the cost per 1,000 of risk remain constant over the duration of the policy. Choosing between YRT and level cost of insurance. Cost of insurance under YRT is lower in early years than the cost of insurance for level cost of insurance costing. That is a lot of cost of this is crazy. The lower cost under YRT means lower deductions from the investment account. Less is paid for the mortality charges and more money remains in the investment account to allow investment to grow. Therefore, a younger policyholder is well served during the early years of his policy by YRT costing because his mortality cost is low. In later years, mortality charges can be quite high and may erode the policy's cash value unless there are higher investment returns to offset the higher cost. YRT is a good choice if the policyholder will qualify for low term rates and he wants more of his deposit to be invested in the early years of the policy. With level cost of insurance costing, mortality cost deductions are higher in the early years. And this means that there are higher deductions from the investment account and less premium invested, which can result in lower investment account value, of course. In later years, mortality cost deductions are lower with level cost of insurance than with YRT, which will help preserve the policy cash value. Wow, this is interesting. Now, I think I'm going to go check out all these level cost of insurance and compare to. A switch from YRT to level cost of insurance may be possible. The reverse, going from level cost of insurance to YRT, is usually not permitted. Yeah. Table 4.1 compares mortality deductions for YRT and mortality deductions for level cost of insurance. For a UL policy purchased for a 40-year-old woman who smokes and is in good health with a death benefit of 500,000 plus account value. Let's see. See, cost of insurance per 1,000 using yearly renewable term. Yearly renewable term. Oh my God. Okay. So YRT is 1,000. YRT cost per fund. Okay. Okay, so the first year is this. Okay, level cost of insurance. Okay, you can see that for this is YRT, the first year is so cheap, right? Making the person to pay less, right? What am I saying? YRT cost per 500 is this. Now, see year 6, this is level cost of insurance. By year 26, they are at par. both YRT and level cost of insurance is the same. By year 21, now YRT is higher than level cost of insurance. Okay, interesting. You see that? You guys, you see? So if you use YRT for client, yes, in the early years, the cost of insurance is lower, all right? And then for level cost of insurance, the cost of insurance is higher. However, look at by year 6, YRT is still lower, but by year, which year was that again? By year 26, they are almost at par. By year 36, YRT is now becoming freaking more higher than level cost of insurance. And by the 36, level cost of insurance is now very low, which will now result in ability to preserve the cash value in this policy. Okay. Guarantee versus adjustable mortality deductions. Okay. You remember we were looking at the three costs of determining premiums that one pays, right? Level cost of insurance, YRT, and the third one is adjustable mortality deductions. Okay. All right, we are making good progress. I'm checking. And then UA policyholders typically refers to assurance of knowing exactly how future mortality deductions are going to be calculated. Insurance companies typically prefer being able to adjust the cost of insurance schedules to reflect their actual experience with mortality investment returns and administrative expenses. Agents should understand policies to determine whether the costing schedules are guaranteed for life or subject to adjustment. Agents should advise clients based on this information. Open-ended or restricted increases. An adjustment in cost may open-ended, no limit to the amount of increase or restricted. Most adjustable policies places a restrictions on increases, such as limiting increases to 25%, 50%, or 100% of the original schedule, or a specific dollar amount. Death benefit options. The death benefit is another flexible option in the universal life policy. There are a variety of death benefit options available. The most common options are level death benefit. Okay, death benefit options. Okay. All right, guys. Now, I don't want us to continue into another terrain without telling you guys that, hey, we've closed a curtain on cost of insurance. All right. And we've talked about the difference. You see, I actually had this conversation a couple of days ago with one of my team members. We were looking at the cost of insurance, different types of cost of insurance, which is YRT, level cost of insurance, and adjustable, and what do they even call it again? Adjustable. Yes, this one guaranteed versus adjustable mortality deductions. Okay, those are the three ways we can specify cost of insurance. So now we've looked into YRT, we've seen that YRT at the beginning, the cost of insurance, because the person is younger, is lower, enabling more money to be put towards investment. However, low level cost of insurance level the cost of insurance across the board. So making higher cost of insurance in today's present age. However, as the person grow older, because his level cost of it gets more cheaper for the person than YRT, all right? And then which enables more the cash value to be preserved in the later years. So now, even me myself, I'm now so curious. I'm going to run illustration on these three types and dissect it. Oh my goodness. If you want, to get together with me on one-on-one, so we can look at this in real practical sense, just leave a comment in the comment section and make sure you subscribe. And then I will reach out for us to schedule a time to do that, the real practical stuff. All right? If you're in my team, you don't need to worry. We'll be working on that by now, or if not, we'll get to it at a later time. Now, we are moving on to death benefit options. Okay? Death benefit options. The different ways that the death benefits are paid. Okay? Now we have level death benefit, increasing death benefit. Do we even have any other one? Which is, all right? So now there are variety of death benefit options available. The most common one are level death benefit plus amount value, level death benefit plus accumulative premium, and also index benefit. Index benefits, do we have that one in Canada? That should be IUL, right? Anyways, we'll see. So they are giving us four here. I'm most familiar with level and increasing, which is death benefit plus account value. Now we have death benefit plus cumulative premium. Cumulative premiums. And then the fourth one is death benefit, death indexed death benefit. All right? Don't forget, because in case they'll ask you, what are the death benefit options that are available to a universal life? There's death benefit, level death benefit plus account value, level death benefit plus accumulative premiums, and index death benefits. I'm sure they're going to explain all this for us. There is also, each one affects the net amount of at risk and the mortality charges deducted from the investment account. Regardless of option selected, the beneficiary receives the death benefit tax-free. Regardless. Regardless of the option selected, you see, the beneficiary receives the death benefit tax-free. All right? Okay. So now we are moving on to talk about level death benefit. Level death benefit. The level death benefit is offered in one of two forms. A death benefit equal to the face amount, regardless of when the life insured dies. For example, face amount is equal to 250,000, death benefit is equal to 250,000. That is level. Okay? Yes, that is level for you. Regardless, whether you have a cash value that is 1 million, your death benefit will be your face amount. Okay? And if you have 250 face amount and you have fund value of 100,000 and you take that 100,000, your death benefit will remain 150. I believe they are going to explain to us as we go. All right. Death benefit equals the policy's amount. So the policy's account value when the account is worth more than the face amount. For example, face amount equal to 250, investment account is 275, death benefit is 275. Since the net amount at risk equal death benefit minus the account value under this option, as the account value grows, the net amount at risk decreases. And so too, the mortality deductions from the investment account. Now, because of the increasing net amount at risk over time, the level death benefit option is the least expensive of the death benefit option to the policyholder. It is most suitable for individuals who do not have and will not anticipate an increase in insurance needs. So let's go back again. What are the 10? For example, face amount. The death benefit equal the policy account value when the account is worth more than the face amount. And they're talking about level death benefit here. See, I'm going back. I'm saying, for example, face amount is 250, investment account is 275, death benefit is 275. Okay, let's keep going. Because what I know with level death benefit, whatever is in the investment doesn't get added to the death benefit, right? Okay. All right, since the net amount at risk equal the death benefit minus the account value, under this option, okay, as the account value grows, the net amount at risk decreases. Okay, we've read this one. Because of the increasing net amount at risk over time, the level death benefit option is least expensive of the death benefit option to the policyholder. It is most suitable for individuals who do not have and will not anticipate level death benefit plus cash value. Under the level death benefit plus account value option, the death benefit is the original face amount of the policy plus the value of the investment account. With this option, the net amount at risk is the level over the duration of the policy, while the death benefit increases. Because the net amount at risk remains level, mortality deductions will be greater and the investment account will grow at slower pace than Llqp policy with a level death benefit. This option is most suitable for individuals who can deposit large premiums in excess of the minimum premium required. Level death benefit plus cumulative premiums. Yeah, I'm curious to know this one. All right, so level death benefit plus cumulative premiums. Under the level death benefit plus cumulative premiums options, upon death of the life insured, the beneficiary received the original face amount plus the sum of all premiums paid. The premiums are actually refunded when the life insured dies with this option. And this is typically the most expensive death benefit options. Okay. And with this option, the calculation is net amount at risk, which is original face amount, plus the cumulative premiums, minus the account value. Now, this option reduces the net amount at risk quickly. The mortality cost deductions are reduced, which allows for the investment account to grow at a faster pace. To the extent that the investment account exceeds the original face amount plus cumulative funds, the insurance company keeps the excess amount. This option ensures the premiums are not forfeited by the policyholder if the life insured dies early in the life of the policy. It is more suitable for individuals who plan on maximizing their premiums. Okay. Index death benefit. The index death benefit is the face amount indexed for inflation. Okay. The face amount increases each year by inflation rate. Canada's inflation rate, as shown in CPI, is currently about 2%. This has a compound effect since every year's increase is applied to and already increased death benefits. Over time, such growth can become significant. Policies index the inflation rate to either achieve the following objectives: the Consumer Price Index, CPI, or the policyholder's choice of, of indexation rate between 1% and 8% when acquiring the policy. However, if the account value is greater than the indexed death benefit, the insurance company keeps the insurance between the two. Under this option, the net amount at risk and mortality deduction increases over time, depending on the index rate chosen by the policyholder. This is a yeah. This death benefit option is most suitable for individuals desiring to protect an end of life risk that is expected to increase over time, that is tax liability on assets that will appreciate in value. All right? Excuse me. Investment components. Yeah. Investment component. Boom, boom, boom. All right. Investment components in the universe of life. Let's see. Let's see. We're making progress. We are moving in chapter 4. All right. You learning something? All right. Investment components. The following features are what makes a UL policy unique from other forms of life insurance. Net premium tax deferral, investment component choices, and impact of return on policy viability. Each will be discussed in details below. All right. Now, net premium. All right. Now, a gross premium is the total amount of deposit or premium paid by the policyholder. So that is the net premium, right? That is a gross premium. Um, da, 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 da. So we move on to the net premium. A net premium is the money that remains after the premium tax, right? It is just like a gross income, net income, typical kind of thing, right? That's why it is here. A gross premium is the total amount of deposit or premium paid by the policyholder. All right. Now we move on to the net premium. Is the money that remains after the premium tax, the mortality charge, and policy expenses are deducted from the gross premium. Therefore, the gross premium minus premium tax minus mortality charge minus expense deductions is equal to net premium. You got it? If you don't get it, Flo, don't forget about it. Go over it again and you will get it. All right. Now, the net premium is invested with the policyholder's investment account. As mortality deductions decreases, the amount available for investment increases, assuming the policy paid remain constant. Okay. One of the main benefits of a UL policy is that it gives a policyholder a way to invest in a tax-sheltered environment. A policy is tested annually to ensure it will be tax exempt. See chapter 7 for more details on the tax exempt. Anyways, we'll get there eventually. If it fails the test, that if more money gets into the plan, and that lead that was covering, the taxes from coming in, or it appears that the policy will fail the test, then the net premium may be reduced by the insurance company so that the money going into the policy's investment will not trigger taxes. In other words, the insurance company limits the amount of the premium going into the policy in premium to maintain the policy's tax-free status. If the maximum net premium is exceeded, the excess is deposited to a side fund of the policy. Investment returns in the side account will be taxable. Tax deferral. What does it mean? Income earned in a universal life policy investment account is tax exempt as long as the income earned remains within the policy's investment account. Investment returns may be reinvested, which leads to compound growth and an increase in an account value. If the debt benefit includes the account value, then the investment growth may never be subject to taxation. That's right. Investment choices. What investment choices do we have? The policyholder is responsible for management of his investment account. And that's where we come in as advisors, right? We work with the policyholder to make some good choices when it comes to choosing this investment account. This differs from other permanent insurance policies, where the insurance company is responsible for the investment of the policy's fund. And that's why there is not as much transparency, right? For example, whole life. The insurance company manages the investment account and the policyholder doesn't have visibility to those investment accounts. Net premiums may be directed towards one or many different types of investment. They include but are not restricted to the following: daily interest accounts. Investment can be into daily interest account. Now, what is daily interest account? Daily interest accounts are accounts that offers a usually low interest rate based on the yield of a specified benchmark. The minimum return is 0% and the principal is guaranteed. As such, returns may only be flat or positive, but never negative. Excuse me. Excuse me. Guaranteed investment account, that is GIA. Guaranteed investment account, GIA, provide fixed interest rate for a return term beginning at 1 year and last up to 20 years. Offers a guaranteed minimum interest rate based on a specified benchmark. Now, the minimum return is 0, so the principal is guaranteed. A market value adjustment or penalty may apply if the policyholder redeems the GIA prior to its maturity. Returns may be flat or positive, but never negative. As a GIA matures, the proceeds are rolled over into a policy's active investment account, unless the policyholder requests that they roll over to a new GIA of the same term. Index funds investment. An index fund investment earns interest based on the returns from a chosen index. Indexes are available based on equities, bonds, or combination of both. Size of market capitalization or objective growth or income. Management fees may be charged against the value of the investment returns. And the management fee may be flat, positive, or negative. May be against the value of the investment, full stop. Returns may be flat, positive, or negative. Then another investment option is mutual funds. Remember, we're looking at investment options. We've looked at VIA, we've looked at index funds investment, and now we are looking at mutual fund investment. A mutual fund investment earns interest based on mutual fund returns. Mutual funds are available based on equities, bonds, or a combination of both. Size of market capitalization, management style, or focused on a specified geographic region. Management fees may be charged against the value of the investment. Again, mutual fund investment returns may be flat, positive, or negative. Okay? Impacts of investment returns on policy viability. So what is the impact? I think we've looked at that. This came up somewhere, but in passing, but now we're going to see the detailed impact of investment return on policy viability. Deposits, mortality charges, expenses, and investment returns affect value of the investment account and must all be monitored by the policyholder to ensure funds are always available in the investment account to cover costs. You see, that's why I love to do annual review with my clients. We get to see those returns, we get to see how they are doing. And I love it. Every time I do that, we get to see, if there's anything we've missed, if there's anything we update, if there's anything that we need to add. All right. If mortality costs increases, then the investment account will grow slowly or may decline in value. If investment returns are lower than expected or negative, then the mortality deductions may erode the value of the investment account at a more rapid pace. A shortfall for costs will require extra deposit to be made or the policy could lapse. All right. Now, policy illustrations. UL policy documentation includes a policy illustration, a chart or table that projects value of the deposits, mortality charges, investment accounts value, cash surrender value, and death benefit for each future year. There are usually two sets of illustrations provided to the potential policyholder. One is based on the current or requested rate of returns, and the other is at a lower rate of return on investment. Insurance agents must advise clients that the illustration is intended to demonstrate how the policy works. It says that the projected returns are not guaranteed and that actual performance may deviate from expected performance. The potential policyholder must sign the illustrations provided to him by his agent as evidence that he has seen the document and understand the illustration of the illustration. Accumulating funds. The investment funds or accumulating funds of a UL policy provides the policyholder with the following non-forfeiture benefits. Surrendering the policy withdrawal, which is partial surrender, premium offset, policy loan, collateral for third-party loans, leveraging and distribution upon death. All these are investment funds accumulated from the policyholder with the following non-forfeiture benefits. All these are non-forfeiture benefits that are available to the policyholder. Now, surrendering the policy. Okay, what does that mean to surrender a policy? Okay. Surrendering the policy. A policy may be surrendered and the policyholder will receive the cash value of the investment account minus any applicable surrender charges. Surrender charges apply up to 10 years after policy is issued. But that's why I love one of our partners, CPP, their own surrender years is just 6 years. Surrender charges is a multiple or percentage of the annual mortality cost that will be charged under level cost of insurance costing. It is deducted from the cash surrender value and can reduce cash surrender value to zero, but not less than zero. For example, if mortality cost is $1,000 and the surrender multiple is 2, then the surrender charge is 2,000. And if the policy cash surrender value is 1.5, it is reduced to 0, right? Now, the charge decline over time and may eventually be eliminated. Tax may be applied to the amount received by the policyholder as withdrawn or surrendering the policy may result in a taxable policy gain. Okay? UL is the only type, okay, no, we are looking at policy withdrawal or partial surrender. UL is the only type of life insurance policy that permits withdrawal. The withdrawal is taken from the cash value of the investment account and is considered to be partial surrender. There is no need to repay withdrawal. Okay? A withdrawal reduces cash value in the account, and if not repaid, reduces the death benefit. A minimum withdrawal amount may be imposed by the insurance company, and the maximum withdrawal is the cash surrender value. Surrender charges as well as taxes may apply to the withdrawal. And because mortality costs and expenses are deducted from the investment account, a withdrawal may be negatively affected. A withdrawal may negatively affect investment growth and the longevity of the policy. For example, Andrew has a UL policy with a level death benefit. You see, remember, this is a level death benefit of 200,000 and a current cash value of 21,000. The policy is based on level cost of insurance mortality costing, with a mortality deduction of 3,800 per year. Andrew lost his job and he is running short of funds. So he is thinking about withdrawing 20,000 from his UL policy. While his contract allows the withdrawal, Andrew should know that it will reduce death benefit to 180,000 and the cash value of the policy would decrease to only $1,000. This puts the policy in danger of lapsing because there won't be enough money in the account to cover the next mortality deductions of 3,800, unless Andrew can deposit additional premium before the deduction comes due. Okay, so this is level death benefit for you. So with level death benefit, the death benefit and the face amount is the same. If the policy grows, and like in Andrew's case, now there's a cash value of 20,000 and he took 20,000. You can see the way that reduces his death benefit to 180K. I think I have mentioned it somewhere earlier. Anyways. All right, premium offset. All right, participating whole life policy provides the policyholder with the choice of using policy dividends to offset their premiums. Premiums are naturally offset by investment income and the policyholder's deposits to the investment account because of the way the investment account of a UL policy works. Depending on the premium deposited into the policy and the investment returns within the policy, the investment account can grow to such a size that it can be used to fund future mortality and expense deductions indefinitely. The policyholder can stop paying the premium while maintaining his policy in force. For example, Walter bought a 500,000 universal life several decades ago based on level cost of insurance mortality deductions of 10,500 annually. Walter always deposited the maximum premium permitted to the policy, and he has made some rewarding investment choices. As a result, the policy currently has a cash value of 460,000. Because Walter is currently 65 years old, he could stop paying premium, and the policy will likely remain in force for the duration of his lifetime because if he wants to do this, he should adjust his investment mix within the policy to those investments that offset principal guaranteed. Mhm. All right, policy loan. A loan is typically limited to 50 to 90% of the cash value of the investment account. Interest is charged on the loan and is set at the time the loan is taken. There is no requirement to repay the loan. Any unpaid loan balance and accumulated interest will be deducted from the debt benefit. Taxes may apply since a policy loan is considered to be a taxable disposition. Really? Now, a benefit of taking out a policy loan rather than withdrawal money from the policy is that funds continue to earn tax sheltered income within the policy's investment account. On the other hand, the interest rate charged on the policy loan may be higher than the return on the funds. Yeah, so that's something that needs to be considered because if you are going to take a loan and the interest, let's say, is 5%, then it only makes sense if your investment return is doing more than 5%. If your investment return is not doing more than 5%, then in that case, it doesn't make sense, in my opinion, right? Joshua had a universal life policy. This is an example that named his daughter Rebecca as the beneficiary. The policy had a 250,000 level death benefit and a cash surrender value of 35,600. When he took a policy loan of 30,000 at an interest rate of 4% annually to help pay for her post-secondary education by taking the policy loan, Joshua also had to report taxable income of 1,800. According to the information provided by his insurance company, 1 year later, Joshua died, assuming he did not take any principal or interest payment on the policy loan. Rebecca will receive death benefit of 218, calculated as 250 minus 30,000 less 30,000 times 4%. All right. Now, the next one is collateral for third party loan. Now, the cash value of the investment account can be used as collateral for a loan from a third party, such as financial institution. The financial institution is assured its loan will be repaid by the policy. Taking a loan from the financial institution instead of directly from the policy avoids any possibility of that. Okay. So in other words, policy loan and collateral loan is the best because with collateral loan, you are not going to pay taxes. Yeah. Depending on how the loan is structured, principal and interest payment may not be required, and the loan and accumulated interest will be paid upon death of the life insured by the death benefit, with the residual death benefit going to the beneficiary. Example, suppose that instead of taking out a policy loan of 30,000, Joshua had taken a 5-year loan from his local bank at 4% interest, using his UL policy as collateral. At the end of the first year of the loan, Joshua made a repayment of 6,738 to the bank, which is 5,538 principal, 1,200 of interest. Okay? When Joshua died 1 year after taking out the loan, the bank receives a death benefit of 24,000, calculated as the 30,000 he took minus the 5,538 that he repaid, and Rebecca, the daughter, will receive 225,538, which is calculated as the 250 death benefit minus outstanding balance for the bank, which is 24,000. Since the investment account value is not reduced by the amount of the loan, it can continue to grow on a tax shelter basis. Policy loan is the way to go, guys. Leveraging. Leveraging is a variation of a third-party loan where a loan can be obtained using cash surrender value and the debt benefit as collateral. Now, the proceeds of the loan are invested according to the policy owner's financial objective. Principals and interest payments are not required, and the loan plus accumulated accrued interest will be repaid upon the death of the life insured by the death benefit, with the residual death benefit going to the beneficiary. If the loan invested to produce, if the loan invested this is the language, I don't understand, to produce property income, then the interest that accrued against the loan is tax sheltered by the policyholder. Using the cash surrender value as collateral avoids any tax liability that might occur if the policyholder took a policy loan or made a withdrawal from the policy. Right. Vital to the success of this strategy is that investment returns must be greater than the cost of borrowing. Exactly my point earlier. If the loan plus accrued interest exceed the cash surrender value, then the lender may demand repayment of the loan. Leveraging can be a dangerous strategy if investment returns are lower than anticipated. The policyholder may have to surrender the insurance policy if the personal funds are not available to make the repayments. The forced surrender of the policy may result in a potential tax liability. For example, Wendy has a Llqp policy with a 500,000 death benefit and a cash surrender value of 260,000. She retired at age 55, earlier than anticipated, and think she may need to withdraw on her Llqp policy to support her retirement income until her CPP and AOS benefits start. However, if she simply withdraw the money from the policy, it will result in taxable income. Instead, she approached a bank about receiving a loan of 10,000 each year for the 10 years using her Llqp policy as collateral, and she will receive the loan proceeds tax-free, resulting in greater after-tax income than if she has withdrawn 10,000 from the policy each year. So Wendy will need to monitor the investment returns and within the policy to ensure that the loan and the ongoing mortality and expense deductions do not reduce the policy's cash surrender value to the point where it's less than outstanding loan plus accrued interest. All right? Distribution of debt. Okay. We are getting very close to the end of the chapter. Okay. So stick around with me, okay? Distribution upon death. The amount paid as the death benefit for each of the benefit options are as follows. Under the level death benefit, we'll say that then the insurance company usually only pays out face amount through some policies will pay out the value of the investment account that exceeds the policy's face amount. Now, under the level death benefit account value options, then now the policy will pay out the original face amount plus the full value of investment account. Under the death benefit level benefit accumulative fund options, accumulative premium option, the policy will pay out the original face amount plus the sum of all the premiums, regardless of the value of the investment account. Any excess that may remain in the investment account is retained by the insurance company. Now, under the index death benefit options, the policy will pay out the original face amount, index accounting, to the rate specified in the policy, regardless of the investment account. Any excess is retained by the insurance company. All right. Advantages and disadvantages of universal life insurance. Universal life insurance offers advantages that it offers considerably flexibility to the policyholder. Excuse me. However, the disadvantage is that product is complex and may be difficult for the policyholder to understand. And that is why it's always important to work with your advisor on this. Policyholder can increase or decrease or even suspend premium as long as the policy account value can support the mortality and expense deductions. Disadvantage is that policyholder needs to actively monitor the performance of the investment account and make adjustments to the policy investment as needed. Another advantage of universal life is that policyholder has a choice of investment products. Yes, the policyholder makes a choice. However, the disadvantage is that entire premium is subject to premium tax. Yes, the entire premium is subject to premium tax. Okay. Another advantage is that it offers the opportunity for tax sheltered investment within the limit. Now, policy performance is sensitive to changes in investment performance. Yeah. Now, comparing universal life and whole life. Yes, I'm sure you guys would like to see what is the difference between universal life and whole life. I'm curious to see that too. Now, mortality deductions and expenses. For mortality deductions and expenses, for universal life, mortality deductions and expenses are deducted from the investment account. Now, for whole life, mortality deductions and expenses are taken from the policy reserves. Now, for universal life, mortality deductions may be based on royalty or level cost of insurance costing. But there's none for whole life because the insurance company manages everything. Now, when it comes to premiums, for whole life, premiums are typically level for the life of the policy, unless it is an adjustable policy. Now, for universal life, it means premium does not trigger a premium loan mortality. A premium loan, mortality deductions and expense continues to be drawn from the investment account. Policy may lapse once the account value becomes insufficient to cover these deductions, subject to a grace period. Now, for whole life, a missed premium will trigger an automatic premium loan. Addition automatic premium loan will be made until the cash surrender value becomes zero. And when the policy lapses, subject to grace period. Wow. All right. When it comes to dividend, universal life does not provide policy dividend. However, whole life policy may pay dividend. The reason why we say may is because even though it's a participating policy, they can only pay if there is excess amount. You get it? Death benefit. For death benefit, the difference between UL and whole life is that policyholder has options with respect to death benefit. For example, death benefit plus account value, death benefit plus cumulative premiums, and stuff like that. But for whole life, death benefit is generally not affected by the value of the investment account. Wow. Modal factor. What is the difference between UL and whole life when it comes to modal factor? Modal factor is for UL is generally are not used. Okay. Now for whole life, modal factor applies if premiums are paid other than annually. Okay. Now investment. Policyholders can choose how the investment account is invested. Before whole life, insurance company chooses how the policy reserves are being invested. You got it? All right. Okay. Now, using universal life insurance. Sorry, all this pop-ups again. UL is most suitable for investment savvy policyholders with long-term insurance needs who are also looking for tax advantage investment opportunities. It is best to use UL policy as an investment vehicle after the repayment of non-deductible debt. Now, maxed out registered retirement savings plan, RRSP, and tax-free savings account. Individuals who have no available contribution room in their RRSP and TFSA can turn to a UL policy to continue to build their tax-deferred savings, particularly if they have a higher marginal tax rate. From a tax-efficient standpoint, repayment of non-deductible debts before using UL insurance policy for the investment purpose is also recommended. For example, Alistair is 45 years old and a senior project manager at an engineering company. His company offers a defined benefit pension plan, which severely limits his personal RRSP contributions. He has already maxed out his TFSC and he is looking for additional tax advantage way to save for retirement. He also wants 500,000 of life insurance coverage to create a scholarship fund upon his death. Alistair may be interested in a universal life insurance policy if he maximizes his premium to the policy. Now, the investment account will grow tax-free if he chooses UL policy that pays out the death benefit plus account value upon death. The entire amount will be paid out tax-free, leaving an even large legacy. That's right. Tax-free retirement income. Leveraging a UL policy could provide a tax-free retirement income. The UL policy provides collateral for a series of loans. The loan replaces income in retirement. Now, in practice, true leveraging is not considered to be appropriate if the person taking a loan for investment purpose has a short-term horizon. That is a short amount of time until the investment principal is needed. Most retirees are considered to have short-term horizon. For example, Joan expects to be in highest marginal tax rate during her retirement, so she is looking for sources of retirement income that will not be subject to tax. She has already maxed out her tax-free savings account and does not want to put more money into registered retirement savings plan, RRSP. And because the withdrawal will be highly taxed due to her marginal tax rate, she can maximize fund, she can maximum fund a UL policy, which will provide tax-free investment growth during retirement. She can obtain a series of loans using the policy's cash value as a collateral because she won't actually be withdrawing the fund. No income tax is triggered. Furthermore, the investment account remains intact, so it can continue to earn tax-free income. Whew. And that brings us to the end of chapter 4. All right, so I'm looking at my time. Now, I want us to go quickly to Q&A for chapter 4. All right, chapter 4, universal life. Okay, reattempt. Okay. Whoa, 35 questions. Oops. So hopefully I can quickly get through this. Okay, no, not this. Not this screen. I think all right. Oh, my eyes. Okay. Question number 1. I wish I can figure out how to expand this because it's getting really, oh goodness Lord, what's this? It's getting really small for my eyes. Okay, now did I over increase it? No, I think I like the font right now, just that I can't see this side, but that's okay. Okay. After staring at the screen for a very long time, my eyes start, but I just want to have this class together in one place. All right, what do universal life policies not provide? Dividend, modal factor, premium, death benefit, dividend. Okay, next. All right, for a UF policy, what is it called when the cost per 1,000 at risk generally remain constant over the duration of the policy? It's called level cost of risk, level cost of level constant risk, level cost of insurance, level cost of cost, level income cost. No, it's level cost of insurance. Okay, next. All right. How many universal life policies can be used to insure multiple lives, either on a joint life basis, a single life basis, or depending on the insurance company, sometimes both? Is one. You don't need multiple universal life. So you can use one universal life to insure single life, joint life, multiple life. Okay. Okay. Now, what accumulates within the policy tax-free as long as certain limits set by the Income Tax Act are not protected? All right, expense income, investment income, tax deduction, accumulated income. What accumulates within the policies tax-free as long as certain limits set by the Income Tax Act are not exceeded? Is it expense income? No. Investment income? I think so. Tax deductions? No. Accumulated income. It's between B and D. Investment income, accumulated income. You see, that's what you see most of the time with this. Investment income is income from the distance, but again, they are accumulated, right? Mm. I'm going to go with investment income, my gut, and then we'll see at the end. Okay. What happens to the mortality deductions and expenses in whole life insurance? They are partially added to the policy. They are taken from the policy. They are added to the policy. They are partially taken from the policy. What happened to the mortality deductions and expenses in the whole life insurance? They are partially added to the policy. No, they are taken from the policy. They are added to the policy. They are partially taken from the policy. I believe they are taken from the policy, my guess, but again, I don't know everything, so we'll find out. Question number 6. If the death benefit affected by the policy, by the value of the investment account for the whole life, if the death benefit affected by the value of the investment account for whole life insurance, is the death benefit affected by the value of the investment account for whole life insurance? Always, it depends, never, not generally. Is the death benefit affected by the value of the investment account of the whole life insurance, the death benefits? Is it affected? You see, when we're looking at when we're comparing whole life and this thing, right, we see that the death benefits is not affected. I'm going to go with never, but again, we'll see. All right. All right. Question 7. What is the name of the term insurance policy that renew at the end of every policy year? Annual renewable term, no. Periodic renewable term, no. Level cost of insurance, no. Yearly renewable term is yearly renewable term. Okay. Now, because of the complexity and flexibility of universal life insurance, what tends to be higher than other form of premium permanent insurance? Investment income, administrative expenses, mortality costs, premium tax. Is premium tax. Okay. How are Llqp policy premiums affected by investment income and the policyholder's deposit to the investment account? How are Llqp policy premium affected by investment income and the policyholder's deposit to the investment account? They are increased, they are decreased, they are offset, there's no effect. How are Llqp premiums affected by investment income? How are Llqp premiums? How are Llqp premiums affected by investment? I'm not sure about this. How are Llqp policy premiums affected by investment income and the policyholder's deposit to the investment account? Premiums, they are increased, they are decreased, they are offset, there's no effect. I'll just go with no effect. Then I'm not sure. We'll see the answer and the rationale. Okay. Question 10. When leveraging a loan, how much of the amount can the policyholder invest elsewhere or to supplement his income? None of the amount. When leveraging a loan, how much of the amount can the policyholder invest elsewhere or to supplement his income? Half of the amount, the full amount, any amount. None of the amount, half of the amount, the full amount, any amount. The question itself is as confusing as confused itself. Okay, the level debt benefit plus dash tends to be the most expensive option. Index premium, accumulate value, fixed premium, cumulative premium. I think it's cumulative premium. Okay. What is it called when the insurance company passes a percentage of the policyholder's premium on to provincial or territory government? Investment income, premium tax, mortality charge, and it is a premium tax. Okay. What type of increase will require the insured person to provide evidence of insurability. Base amount, minimum amount, face amount, maximum amount is face amount. Okay. Ooh, let's do this real quick. Which death benefit option does the policy pay out the original face amount plus the full value of the investment account? Level debt benefit, no. Level debt plus account value. Level debt plus cumulative premium index, no, it's level plus account value. Okay. Question 15. When a permanent insurance policy builds up a policy reserve over time, what is decreased for the insurance company? What is decreased for the insurance company? Yes, amount at risk, yeah. The amount at risk is the answer. However, the option here is renewable, no. Level cost of insurance, no. Surrender charge. You see, when they say what is decreased to insurance company is the amount at risk. But if they had said what is decreased to the policyholder, the answer would have been surrender charge. Okay, guys? Now, for universal life insurance, for universal life insurance, who chooses how the investment account is invested? It's the policyholder, of course, not the life insured, not the insurance, yeah. Okay, it's the policyholder. 17. Which investment offers fixed interest rate for 1, 2, 3, blah, 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 even 20 years then? Select one. Index fund investment, mutual fund investment, daily interest rate, guaranteed investment account. Which investment offers a fixed interest rate is guaranteed investment account, I believe, because index is index in mutual fund, daily interest, no, is guaranteed, I will say, but we'll see. Question number 18. Which option may be subject to management fees, which will reduce investment performance? Guaranteed investment account, mutual funds, treasury bill, daily interest account. Guaranteed investment account, mutual funds, investments, treasury bills, daily, I think it's mutual funds investments. Which UL policy will impede the growth of the investment account and may add the long-term viability of the policy? Offset, withdrawal, or surrender? Loan. Which UL policy will impede the growth of the investment account and may add the loans? Offset, withdrawal, loan, surrender? I think it's withdrawal. Which policy? Which UL policy impede the growth in the investment account? I think it's withdrawal. Okay. And may add long-term viability. No, and may add the long-term viability of the policy. May impede the growth in investment account and may add maybe loan. No. let's go with loan and see. This is why sometimes it's good to read this again and again, right? If a client is looking for a greater short-term policy fund value, which option would they typically go with? Term 100, no. Yearly renewable, level cost of insurance, whole life. If the client is looking for a short-term policy fund value, short-term, I would say yearly renewable term. Short-term. That's it. 20. Which universal life policy charges is usually calculated as a multiple of percentage of the annual mortality deductions that will apply under level cost of insurance costing. Withdrawal, offset, surrenders, and loan. Is surrenders. Okay. Next. What may the insurance company limit for policyholder to ensure that the policy remain tax exempt? Net premium, account value, index premium, cumulative premium. Index premium, account value, cumulative premium, is net premium, I would say. But again, guys, for a Llqp policy, what does insurance company deduct from the policy's investment account? Mortality cost, premium tax, administrative expenses, investment taxes. For a Llqp policy, what does the insurance company deduct from the policy's investment account? Mortality cost, premium tax, administrative expenses, investment tax, maybe mortality cost, not sure. Premium tax, all this. For a Llqp policy, what does the insurance company deduct from the policy's investment account? Hmm. Which benefit might be appropriate to cover end-life risk that is expected to increase over time? Cumulative, index, fixed, accumulative is index. Which type of person is described as appropriate for choosing universal life insurance? Experience with insurance, tech savvy, investment savvy, business oriented. I would say investment savvy. Okay. Under what option does the level death benefit equals to original face amount of insurance of the policy? Under what option does the level death benefit equal the original face amount of insurance of the policies? Cumulative, fixed, index, account value, fixed. Not entirely sure about that, but I just want us to quickly finish this. What is not an advantage of universal life insurance? You're looking for the wrong answer here. Offers less flexibility to the policyholder. That is, this is offer less. No, it offers flexibility. Offers little opportunity for tax shelter. No. What is not an advantage? Entire premium is subject to premium tax. Policyholder has limited choice of investment program. Okay, so it's like when we say what is an advantage of and what is not an advantage of UL insurance, what is not an advantage? Offer less flexibility to the policyholder, offers little opportunity for tax shelter investment. It does offer this thing now. Entire premium is, yeah, this one is not an advantage. Entire premium is subject to premium tax. I'll go with this one. My eyes, oh my God, 28. With Llqp policy, there are three pricing factors that are not necessarily fixed. They are called unbundled. Have whole life bundle, they are called unbundled. Yeah. All right. Which type of investment does not acquire a legal interest in the fund or in the securities that make up the index? Guaranteed investment account, index fund investment, mutual fund investment, daily interest, does not acquire a legal interest in the fund. I have no idea what the securities. I'll just get daily interest account and then we'll see. What do the modal factor almost always reflect that the policyholder must pay to the insurance company in exchange for spreading the premium over a series of payments? Maximum charge, no. Minimum charge, no. Interest charge, non-interest charge is the interest charge. What do the modal factor almost always reflect? It reflects interest charge, okay? I thought I clicked next. Okay, that was a bit hangy there. Okay. Which investment offers a minimum interest rate based on the yield of the specified benchmark? Guaranteed investment account, index fund investment, mutual fund daily interest, minimum based on yield of specified benchmark. I'll go with guarantee because it mentions specified, but again, we are 4 questions away from finding the truth. Which death benefit option does the insurance company only pay out the face amount? Although some policies will pay out the value of the investment account that exceeds the policy's face amount. Index death benefit, level death plus accumulated fund option, level death plus accumulated level death benefit option. They say which death benefit option does the insurance company only pay the face amount? Is, did I say index? Jesus Christ. Level debt benefit. Gosh, please, guys. Let's try to read very well. Okay. What are the premiums typically for whole life insurance? High, decreasing, low, level. They are level, right? I think so. 34. Which debt benefit option will pay out the original face amount plus such of all premiums regardless of the value of the investment account? Level, no. Index, no. Level plus cumulative premium, yeah. All right. In tax deferral, which investment income is allowed to be fully reinvested within the policy? Half, whole, gain, and. So in tax deferral, which investment income is allowed to be fully reinvested within the policy? I think it's everything, right? Gain and or earned income. Which income is allowed? Earned income. I am not sure. We'll find out. Have we finished? Oh, okay. All right. So I'll check to be sure that all your answers are saved. If we missed any, this is where you will know, okay, anyone with the answer. All right. So submit and finished. Ah. Oh, that's a good one. We meet 1, 2, 3, 4, 5, 6, 7, 8. So we got, we missed 8 out of 35. Okay. Okay. After, you see, this finished 24 minutes. We did this in 24 minutes at this second. Grade is 77%. Oh, unfortunately, you did not score at least 80%, which is what they recommended. So they recommend you score 80%, and then so we urge you to try again. Now, so again, the recommendation is to aim to score 80% when you are doing all these practice questions. Now you have an edge now because you're with me and you are watching this. By the time you go to do this on your own, you have an advantage. Now I'm not going to go into some of the questions we have scored. If you want to read it, now you can pause it and read it, okay? The one we get it right, you can pause it and read it so that I can explain the one we did not get. All right. Again, feel free to pause it and read the rationale. Okay. All right. Oh, we didn't get this one. So it says, is the debt benefit affected by the value of the investment account of the whole? I will say never. We say no, it's generally not. Debt benefit is generally not affected by the value of the investment account. So what is the difference between never and generally not generally? Nah, these people, eh? Okay, we got this one. Oh, we didn't get this one. So this one is where they were asking about, because of the complexity of the UL insurance, tends to be higher administrative expenses. Because of the complexity of the flexibility of the UL, the administrative expenses tend to be higher than other forms of permanent insurance. Really? I thought it's premium tax. Oh, higher. Wow. Again, this one. Oh. Okay, please read this. Pause it and read the rationale, please. Okay. Again, back to back this. When leveraging loan, how much of the amount? Okay. Oh, the answer is full. And okay. Please pause it, read it. Okay, now we got this on cumulative premiums. Okay, and we got this on premium tax. You see, I recommend you pause this, read it line by line, because when you read it, especially the rationale, even though we get it, pause you to read the rationale, okay? Now, if you have any question, leave it in the comment section. I'll come back and check and respond. Okay, that's why I'm scrolling slowly to it. You can pause it at any point. Okay. Okay, this one we did not get it. It said, which UL policy will impede the growth of the investment? The correct answer is withdrawal. Oh, interesting. Okay, please read the rationale, please. Then we got this one. Did you get this one? Yeah. We got this. We got this. And this. Oh, we didn't get this. Under what option does the level debt benefit equals the original face amount of insurance of the policy? We say fixed cumulative index account value. Oh my God, you see that? So again, let's try and read all this. We didn't get this one. Which type of investment does the acquire that does not acquire a legal interest? We say daily interest rate. The answer is index fund for all. All right. So pause this, read the rationale, my darlings. So yeah. Okay, now there you have it. We have come to the end of this class, and I'm super happy that I was able to put together the chapter 4 and chapter 4 question and answer all together in one class for you. If you find value in this effort, please don't forget to subscribe, and I'll see you in the next class when we move forward onto chapter 5. Until then, bye for now.